I'm Ryan Lightfoot-Brown of Fund Calibre. We're joined today by Graham Clapp, manager of the RWC Continental European Equity Fund. Thank you very much for joining us.
Good morning, nice to be here.
Now, part of your process is company meetings, going out and meeting the managers of these companies run. It always has been. Has your approach to this changed over time? Are you still asking the same questions, or has anything developed in the time you've been running?
Well, you're absolutely right, Ryan. The company meeting is absolutely the core of our process, and I've done 15,000 of those now since I started my career. The primary objective of a company meeting hasn't changed at all. It's to try and determine what we think the fundamental performance of the business is going to be, and to compare that with the valuation of the company. Now, clearly, in the very early days, back in the 90s, when we were doing these company meetings, a large part of the meeting was to find out what the company thought their prospects were. Now, obviously, over time, information flows from companies to investors have improved pretty significantly. And so now it's not so much to understand what we think the company think their prospects are, because we already know that. The questions we're asking now is more, why do they think? What are the assumptions they're making? And how might things be different from the guidance that they've given investors as a whole? And so, in a nutshell, I guess, the process is still very much driven about the same aims and objectives, but the questions have changed more from the what questions to the why questions.
Now, if we can just touch on a couple of your holdings, maybe one that our viewers have heard of, like HelloFresh, and one that they haven't, maybe Grifols, and we can maybe talk through those.
Yeah, so those are both good examples of the types of companies that we like to look for. Mid-cap companies in interesting industries which may not be particularly well understood. So if we take HelloFresh, obviously that's a pretty new business. It's only been around for 5 years or so with the meal kit business. And what do we like about that business? What we like is that, first of all, it has the potential to be very profitable. And when you're investing in new growth companies, internet-based companies, a lot of them can grow. The question is, can they grow profitably? And if you look at a number of companies, like, for example, let's take Ocado, obviously, an online supermarket business, same sort of industry. I mean, the interesting thing is that, HelloFresh has grown to a slightly, the same size as Ocado in 5 years when it took Ocado 20. And part of that is that the business has got high returns, it's the ability to grow quickly, and we believe it has the ability to be very profitable when it reaches scale. So, HelloFresh IPO'd about 2 years ago now. We bought the stock a few months after the IPO. Our expectation is that the profitability of the business will continue to improve as they get economies of scale in their fulfillment business, and that their marketing costs as a percentage of sales will come down as they become better known. So, that's what we like about HelloFresh, and that stock, even though it's done pretty well in the last few months, we still see the potential for that stock to at least double from here in the next year or two. Looking at Grifols, again, an interesting business, not so well known, certainly to the general public. Grifols is one of the top players globally in making in products that are made out of blood plasma. So Grifols, companies like Grifols collect blood from donors, mostly in the United States, interestingly, because in the United States you can pay people to donate blood. In Europe, generally you don't. So guess what? A lot more people donate blood in the United States. So anyway, they collect blood, they purify, they fractionate out the plasma, and from the plasma they fractionate out products, the main products being IVIG, immunoglobulin, albumin, and factor VIII. And those products are used, IVIG is used in anti-immune diseases, albumin is used in a number of skin and other disorders, and factor VIII is actually a small part of their business now, because that's used for haemophilia, etc. And actually you can make factor VIII artificially now. So, factor VIII made from derived from blood plasma is only used where in the cases where recombinant doesn't work. But the nice thing about that business, it's a growth business. The use of these products is growing. There's a potentially really exciting new application for albumin in that recent trials have showed that could be an effective drug for Alzheimer's, and as people may know, there's virtually no effective treatment for Alzheimer's at the moment. It can be somewhat cyclical, mostly to do with the cost of collecting the blood. And right now, in the last couple of years, their margins have come under a little bit of pressure because the cost of collecting the plasma has gone up. And now we expect those margins to expand as they've been able to collect more blood. So Grifols is an interesting business for us. We see margin expansion and good growth.
Excellent. And at the top, you said that you liked mid-sized companies. Why is it that you like going in specifically, not sort of the large or small, just right in the middle?
The two main reasons we like to look at mid-cap stocks. The first is that they're not as well researched as the large caps. So if you look at the very mega cap stocks, they'll be covered by 10, 15, 20, 30, 40, even 50 sell-side analysts. And so every little detail of their business is analysed into the nth degree. The nice thing about mid-cap stocks, particularly actually in a post-MiFID world, is that fewer analysts are covering them. So, and indeed they're covering them less thoroughly. So the opportunity to find businesses which are being misunderstood it's greater. And so that's the first reason. The second reason is that actually generally mid-cap stocks do pretty well because it's easier for a mid-cap company to become a large company than it is for a large company to become a very large company. So those are the reasons we concentrate on big caps.
Okay, and going sort of a bit higher up on Europe as a whole, what's sort of your outlook for the economy at the moment? Are you worried about the trade wars spilling over into Europe once Trump's dealt with the China situation?
Look, clearly there's, we've been in an environment for the last sort of 18, 24 months of concern over trade war. And bear in mind, by the way, the companies that we invest in Europe, they're headquartered in Europe, but often they're global businesses. So a lot of the companies the global businesses we look at, they'll have a big business in America and a big business in Asia too. And so trade wars have already been impacting the companies that we look at. Specifically on the economy in Europe, I see the economy in Europe as sort of neutral. I think the environment is okay. If you look at government finances, they're in pretty good shape in most countries. If you look at unemployment rates, they've come down to nice levels at the moment. If you look at current account balances, they're in good shape. So most economies in Europe are in good shape. Having said that, we don't expect dramatic growth. European economy, the workforce is stable. In some cases, actually, in some countries, even declining a little bit. We're getting good productivity in new areas of the economy, which is where we're excited. But overall, I see the economic outlook as broadly neutral.
Okay, great. That's been really interesting. Thank you very much for joining us.
Lovely. Thanks very much indeed.
And if you'd like to find out more about the RWC Continental European Equity Fund, please visit fundcalibre.com.